Welcome back to the SVN channel. I'm Walt Arnold, Managing Director at SVN in Albuquerque, New Mexico. And today we're going to talk about returns on commercial real estate. We're going to also use we're going to talk about one of the most widely used returns, which is the cap rate. And how do we get the cap rate? What does the cap rate mean? Well, the word for cap rate is actually capitalization rate. And it's a return on commercial real estate. It's a return on investment commercial real estate. We have to have tenants. We have to have income from the property that produces a return for me. If I want to buy a property, I want a return on that money, and I need to analyze and figure out how do I get that return. And one of the most widely used is the capitalization rate. So how do we get there? So the capitalization rate is the income minus the expenses, and that's going to equal NOI. That's a very, very important word in commercial real estate. It's a net operating income. It's a measure of return on a cap rate. It's without any debt. There's no mortgage. So if I have $1 million cash and I want to go out and buy a property, I can use a cap rate very, very well, because it's going to tell me what do I need to buy that property to receive a certain amount of return. So let's break it down a little bit more. Take the income, which is, say this property produces $100,000 a year in income. Expenses are $30,000 a year. My NOI, my net operating income, is $70,000. So then I have to figure out, okay, well, how do I get to the cap rate? What does that mean? What's all that about? There are several different ways to figure out the cap rate, but today we're going to use the most basic way to figure out, and the ways that most investors look at it and analyze it. And those really kind of three components. Where is the property located? And what is the location of the property? What are the strengths of the tenants? And really, what is my risk? I mean, how is that risk? Risk is a big part of real estate. How do you view and analyze risk? Well, it depends on if it's a Walgreens, I have less risk. If it's a shopping center in a local market with local tenants, that might be a little bit more risk. So that influences the cap rate. So let's go back here. So NOI divided by the cap rate equals the value. So here again, we have the NOI of $70,000. That's $70,000 of NOI, net operating income, divided by, we're going to say, no, let's give this property 8.5 cap. So if I want a return of 8.5%, and to achieve that, my price for this property would be $823,529. That would give me an 8.5% return if I receive $70,000 net every year. One very important thing about cap rates is the higher the cap rate, the lower the property value. The lower the cap rate, the higher the property value. That's very important, because a lot of times the people get that backwards. But so, for example, in this property, if I had $70,000 of net income coming in every year, net operating income, NOI, net operating income, divided by, now I want a 10% return. Well, I can only pay $700,000 for that property. So obviously, the higher the cap rate, the lower the return. The lower the cap rate, the higher the return. There are a lot of different ways to measure returns in commercial real estate. And today we're just talking about the cap rate, but there's also the cash on cash. There's also the internal rate of return, and there's the financial management rate of return. But today we want to just go over and give you a little synopsis of how do I figure out the cap rate? What does it mean? And what do I need to achieve my returns? And what do I need to do to figure it out? Thanks for watching. If you like this video, please give us a thumbs up. And we look forward to talking to you soon on other ways to value commercial real estate.